All right, in today's lesson, I am going to cover with you stocks, bonds, and mutual funds. And I want you to be able to understand the difference between one and the other. I want you to be able to understand how one fits into your investment portfolio. At some point, you will become an investor. And when you do, I want you to understand when it's more appropriate to have one versus the other. So we're going to get into it so you understand. I'm going to start with stocks. So stock is buying a share of a company. So I want you to think of a stock as, see if I can draw this. I'm going to start over. There we go. So we have a cube, painstakingly enough. And I want you to think of a share as one of these guys. So if you purchase one share of a company or you purchase two shares, then that's going to eat this up. So imagine that the entire company is broken up into a million pieces. So when you own stock, you have shares. If you're familiar with the movie Tommy Boy, there's a scene when there is a shareholders meeting and they're trying to decide collectively what the direction of the business is going to be, if they're going to sell it or not. Well, that room and those people around the table are called shareholders because they hold shares in the company. So when you buy a stock, and let's say that you bought Apple stock, and Apple is currently at, let's say it's at $110. The value of the share, the value of your stock, when it goes up, then your portfolio goes up. If you bought 1 million shares at 110 and it goes up if it goes up $100, you've doubled, in essence, the value of your portfolio. So when you own stock, you have a share, you're a shareholder of a company, and that makes you part owner of the company. The other option you have as an investor is to buy bonds. So you could also invest in Apple, not through stocks, but also through bonds. So a bond is an IOU, or what I call as a promise to pay you back. So the way the bond works is that you could buy a 1-year bond or a 3-year bond, a 5-year bond. And what the bond is the company is trying to raise funds or trying to raise money. And in the process, they sell bonds. What you're doing is you're lending money to, in this case, Apple. You're lending money to the company. They promise to pay you back plus an interest. So if you bought a $1,000 bond and it was a 3-year bond and it paid 8%, at the end of year 1, your bond would pay you $80. At the end of year 2, the bond would pay you $80. At the end of year 3, it would again pay you $80, in addition to paying back your $1,000. So in total, your $1,000 investment got you $240. Now, 8% is an incredible return on a bond. It's typically, you're not going to see bonds paying that rate or that high. But this is the illustration. So what I want you to be aware of is, in the first example that I gave you, if Apple stock went from 110 and doubled to 220, and you had $1 million in Apple stock, then your $1 million would have grown to $2 million. But let's say that you had bought a bond in Apple and the value of the stock doubles. What happens to the value or the price of your bond? Ultimately, nothing. Your bond stays the same because this is a contract, and the terms of the contract are that you lend Apple this money, they pay you this interest rate for this length of time, and then they return your money to you. Now, the flip side is that Apple could go from $110 to $220, or it could go down to $55. It could get cut in half. Now, if it gets cut in half, the value of your bond stays the same. So you have that security. Also, if Apple were to go down to zero, let's say that our government discovers that all along Apple was being run by some foreign entity and they were using the technology inside these phones and iPads to spy on us. And so ultimately it gets shut down and the value of Apple goes to zero. Now that is an extreme example, but if it goes to zero, then that means that your $1 million in Apple stock goes to zero as well. It has zero value. But if you were a bond holder and you weren't an owner, but a lender to Apple, if you were a lender, then if the company goes to zero, the bondholders get paid before the owners do. So in the process, Apple would liquidate. They would sell their property, their intellectual property. They sell their buildings. They'd sell everything because they went out of business. So whatever they have left over, they'd gather up all that money and they would have an obligation to pay their bondholders first. And then if anything's left over, that would go over to their shareholders. So owning a share of a company, a stock, is being an owner and then being a lender. So this is important because you may have been in a position where you've lent money to a best friend or you've lent money to a sibling. And you've asked yourself, will I get that money back? Are they going to pay me back? Well, and if they pay you back, are they going to pay you back with interest? You might feel a little weird charging interest to a friend or family member. But when you lend money to a company like Apple, they're not going to have a hard time paying you back. You could lend money to Amazon in the form of a bond. It's a promise to pay you back plus an interest. So a lot of security here. While a stock has the opportunity and the ability to skyrocket, double, triple, quadruple in value, the bond doesn't. But you have the security inside a bond that you're not going to lose money, plus you're going to earn an interest. Whereas in the stock, it could all go to zero or it could grow. So those are the two primary distinctions between a stock and a bond. And you could have both in your investment portfolio. So if you wanted to invest in the stock market, if you want to invest in some publicly traded companies, you could put some money in bonds, which is going to grow probably in the neighborhood of about 2%. Not a great interest rate, but very secure. And you can invest in stocks, which have the opportunity for greater growth, but also open you to risk as well. So that's stocks. Those are stocks and bonds. Let's look at mutual funds. So mutual fund is a basket of stocks, bonds, or both. That's number one. Number two, this basket is professionally managed. Now, what does that even mean? Well, you're going to have a basket, and not like an Easter basket, but basically it's going to be a collection of hand-picked stocks, hand-picked bonds to fit into a mutual fund that's going to perform for you. And it's professionally managed by people that have gone to school, have studied, and have learned to find winning companies or companies worth investing in. So you may be a doctor or a carpenter, and you spend plenty of time learning your trade, honing in your skill, and you are very good at what you do. You make good money, but you don't have time to get into understanding, studying stock markets and balance sheets and picking the right winner, the perfect company to invest in. So If you don't feel comfortable doing that and you do want your money to work for you, you want to make it grow, then you have a mutual fund as an option. The mutual fund is going to have not one winner, not one stock, but it's going to be a collection of companies in either, you can get a mutual fund that has all stocks, but a variety of stocks within. You can get a mutual fund that has all bonds in a specific sector. So you might want to do technology, or you might want to do medical equipment, or pharmaceutical. So if you think that the medical industry is going to grow in the next 10 years because we have so many advances in technology, and we're going to be able to find cures and many wonderful things that are going to help us live healthier and longer, then you might want to invest in biomedical firms. But if you don't know those firms, you don't know the industry that well, you say, well, I want to invest in that sector versus investing in that one company that you don't know if it's going to produce or not. And then there are mutual funds that have both stocks and bonds, and it is a blend. Because they're professionally managed, they are rated. So they get a score on how well they perform, and you can see their track history. But when they're professionally managed, they also bring on fees. So another way to invest your money, if you don't want to pick the one winner, is to invest in an index. And I'm going to cover that in the next lesson. But as of now, we understand what a stock is, what a bond is, and their risk levels. So one is more secure, but you're capped at what your growth is, what they're going to pay you back. And the other has the opportunity for a lot more growth, or the opportunity to lose altogether. But that's just added risk. And what you want to do as an investor in the end is, your number one objective is to protect what you have and then be able to grow your money safely. So in the next lesson, we'll cover index funds and other investment products.